Backlogs, still one of the most widely discussed issues in real estate and the economy, have drawn attention to a severe lack of available housing over the past year. We can't seem to get our eyes off the headlines theorizing that the housing shortage is the reason why home prices remain so high and why a housing market crash cannot occur. But what if I told you, like Morpheus and Asterisk, the Matrix Asterisk, that the housing shortage theory is all an illusion? What if I said the shortage is over and that a housing market crash is now inevitable? This is precisely what we are going to dive into today. In this video, we'll discuss the open inventory position in the U.S. housing market and what it implies for home prices over the next 6 to 12 months. If you're into real estate, or even if you're not, but have a bad feeling about the economy, this video is for you. So sit tight, give us a like, and don't forget to subscribe. Wherever you look, you see the headlines about a lack of inventory driving up home prices. Many have argued that home prices would not decline since the inventory situation has been so tight. For context, in 2022, the total number of single-family home sales in the United States reached 4.8 million, making up a significant portion of the economy. Sales of previously owned homes accounted for 87% of these transactions, while sales of new construction homes made up around 13%. For those of you who are new to this industry, let me explain it differently. Sales of previously owned homes are known as existing home sales, whereas sales of freshly constructed properties are called new home sales. Since the end of 2020, the pace of single-family home sales was over 7 million annually. Fast forward to today, and we've seen a decline in the total volume of transactions by 2.2 million units, or 31%. The culprit? Rapidly rising mortgage rates, making homes unaffordable at today's elevated prices. Demand has dropped significantly. Hashtag low supply or low demand. Since the housing market can hardly support a 4-month supply, many people conclude that prices for homes must rise. A scatter plot with the month's supply of total U.S. housing on the bottom axis and the home price growth rate 6 months from now on the left-hand axis shows today's monthly supply reading of 4%. This implies home price growth 6 months from now could be close to an 8% annualized rate. Not bad. But there are nuances to the story. The main one is this. We have evidence that prices are already decreasing. The S&P CoreLogic Case-Shiller National Home Price Index for August showed that home prices are falling at a 4% annualized rate. This marks a complete collapse from the 25% gains seen at the beginning of 2022. It's the first time home prices have declined in over a decade, raising questions about how this is possible given the low month supply of housing in the market. There are currently 3.2 months' worth of existing homes and 9.2 months' worth of new construction on the market. The contrast with the economy only a few months ago is striking. At the beginning of 2022, the supply of existing homes dropped to a historic low of 1.5 months. The housing market in 2021 and 2022 was horrifyingly unhealthy. Mortgage rates plummeted to 2.5%, a level that nobody thought was possible, generating a tremendous wave of buying and refinancing. Hashtag mortgage rates and locked-in homeowners. Everyone locked in that 2.5% rate, and now with mortgage rates hovering over 7%, it's a no-brainer. If you hold an existing mortgage at 2.5%, you're unlikely to sell your house unless you're facing extreme duress. No one wants to trade a 2.5% rate for a 7% rate. This unique situation has created a phenomenon where inventory is low, not because demand is high, but because homeowners are unwilling to sell. For the first time in recent memory, a portion of existing home stock that would typically hit the market is being held tightly by homeowners. These houses will never be listed for sale and will never reach the market, keeping total inventory numbers artificially low. Since existing home sales account for the vast majority of market transactions, 87%, this trend has had a profound impact on the market dynamics. Hashtag the new construction story. New construction homes tell a completely different story. These homes don't have a previous owner and are usually sold by companies that don't like to hold inventory for too long. The monthly supply in the new home market is rising, hitting the highest level since 2008. Demand for these homes has dried up due to the 7% mortgage rates. Home builders have tried to cope by offering significant concessions on sales. Initially, builders kept the sticker price the same but added perks to reduce the effective cost of transactions. However, those concessions quickly turned into outright price reductions. According to a poll by the National Association of Home Builders, 24% of builders reduced pricing in September. You might think that builders holding on to inventory longer is not your problem. After all, they profited immensely during the boom. But here's the catch. Home builders are price setters. They will only hold inventory on their books for so long before selling at a discount. If builders start selling houses cheap, the rest of the market will follow, and the results won't be pretty. ##### flippers and the housing bubble. Mounting evidence suggests that the notion of the 2007 crash being caused by subprime borrowers is plain wrong. An NBER working paper argues that wealthy and middle-class flippers and speculators caused the Great Recession's housing bubble to burst. They wrecked local housing markets when they defaulted at a massive scale. The study analyzed a huge dataset of anonymous credit scores from Equifax and found that the biggest growth of mortgage debt during the housing boom came from those with credit scores in the middle and top ranges. These borrowers were the ones who primarily defaulted, not subprime borrowers. While subprime borrowers usually default at high rates, they didn't during the 2007 collapse. Instead, it was the wealthy flippers who set the stage for the crash. #### why this matters now. If flippers start struggling again, it could mark the beginning of the end for the current market. Flippers could inaugurate the second biggest drop in home prices in recorded history. With new construction homes flooding the market and flippers unable to offload inventory profitably, the pressure on home prices will become immense. ###the bigger picture. While existing home inventory is constrained, new homes are stacking up. Mortgage rates, inflation, and economic uncertainty are creating a perfect storm. For homeowners, the incentive to sell just isn't there, while for buyers, affordability has become a distant dream. The situation creates a standoff that cannot last forever. Builders are starting to crack under the pressure. Discounts are becoming more frequent, and the longer homes sit unsold, the deeper the cuts are likely to be. This doesn't just affect new homes. As builders lower prices, existing homes will have to compete, dragging down values across the board. #### conclusion. So, is the housing shortage over? In some ways, yes. But it's not a shortage of available homes that's driving prices. It's the unwillingness of homeowners to sell and the inability of buyers to afford what's on the market. This standoff can't last forever, and when it breaks, it could do so in dramatic fashion. What are your thoughts on this alarming situation? Let us know in the comments section below. If you found this video insightful, give us a thumbs up, and don't forget to subscribe for more updates on the housing market and the economy. Thank you for watching, and we'll see you in the next video.